Do you think that the royal family live in like primitive times? Like, what do you think their life is like? Like there's a
fucking cruisy.
Like there's a king now, like a king.
He's the king.
So he's not the prince. It was Prince William, right?
What? It's Charles.
Charles. Who's William?
His son. He's the next king.
Oh, he's the next king.
Like, I'm the king. The king is in the house. Can you imagine? Imagine Charlie walking upstairs. The king is home. So funny.
Like, what do you reckon their life is like, man?
I don't know. I mean, I think it's probably stressful in their own way, right? Like, there'd be so many demands on their time. Got to go to this engagement, fly over here. The bloody Australians are kicking up. Can't settle them out.
It's funny you say like everyone's got their own stresses. Like I was telling you the other week, Julius was upset because his friend threw his moon ball over the fence. Like that's their stress.
Yeah,
like, everyone's got their own stresses, right?
Yeah, you create your own stress for whatever reason.
News. What happens now? Charles is king. What happens now that Charles is king?
There's a push
I don't know.
towards republic.
Does any of this mean anything to you?
Like really, I kind of like the concept of it. It's kind of like the history of it, the tradition.
See, I
think it's kind of cool.
Did you used to watch Downton Abbey?
No.
Really?
Yeah, no.
Deb watched it. I didn't really.
I watch.
It was cool to watch, like how they lived and what they drove in the house and all those things. That was pretty cool.
What was that recent one? Bridgerton. I've watched that. That's pretty cool. I watched The Crown. The Crown? Yeah, I watched Crown for a bit. It's really interesting to kind of see how her reign started. Like she's in Namibia or South Africa or Zimbabwe, and kind of just that, your dad's died, you've got to get back. The king has died. Or, you've got to get on a plane. You get off the plane, you're the queen, and you've got all this, imagine that. Just what a head spin. Crazy.
The only thing I can relate to that is like the school calls and like, your kid's sick, you have to come pick the kid up. It's like, I'm going to drop everything. That's the closest thing that I can get to that.
Yeah, nuts.
We ready to roll?
I think we're ready, man.
All right.
What are we, episode 31?
Let's get into it. Welcome everyone, episode 31 of the Wide Lens podcast. I'm Robert Baharian and I have my co-host.
Look out, I've been promoted, people.
Here, Matt Rigby. We're going to cover the latest topics in financial markets and also the latest in what topic would that be? The Queen's death.
I don't know.
Royalty.
Bit of a somber black cloud hanging over the podcast.
I wonder
today.
what this means for the stock market. Has anyone done any analysis on that?
No. Doesn't mean anything. It means a lot for her family, obviously.
Yeah. All right. Now, we're getting off track here. We're recording this on Friday the 9th of September. And did we say it's episode number 31? Let's get into Matt's Market Minute. And we've got a bit to kick off today.
All right. So the Aussie market basically flat for the week, down 9.98. Let's call it 10% year to date. No real earnings of note, so I'm going to skip that. A few company announcements. Air New Zealand down about just over 1.5%. Announced they carried 21.6% more passengers in July of this year than July of last year. I'm surprised it's not more.
Only 21%?
Yeah.
Air New Zealand. As in,
they were in lockdown this time last year, right?
Yeah, I can't remember.
I don't know. I feel like everyone was. Anyway, I think they were. Seven West down about 3%. Announced a new AFL rights deal from 2025 to 2031. Again, surprised me on the downside. Paying an average increase each year of about 3.6%.
Average increase of what?
On their fees.
Oh, on the rights deal.
Yeah.
Right. Well, that's good. Inflation's at 9, so that's a good deal.
Yeah, that's what I thought. Like AFL, surely they've got bargaining power.
I don't know.
Maybe
Just,
not.
it's
Maybe
like
it's a big number
like
up
a
front.
commercial lease, right?
idea.
You just, it's like a nominal amount, maybe.
Yeah, maybe. I don't know. They didn't say how much they're paying. I'm sure it's a lot. Metcash down about 1.5. Trading updates suggest consumer behaviour hasn't really changed, so people are still spending and spending strong. I think up around 10% for the start of this financial year compared to the start of last financial year.
Did they give any insight into different whether people are buying different style of products, different brands, or
Not that I saw. I didn't read a lot into it. I think it was just a brief trading update.
That's interesting.
I'm not sure. Yeah, so still spending. And Tyro, the payments processing business, received a bid at $1.27. The board pretty quickly rejected that. I think shares are trading above $1.30, I think. So market expecting more there. The Nasdaq up about 1.3%, down 25% year to date. 56 stocks down more than 20%, 17 in positive territory. S&P 500 up around 1.75, down 16.5 year to date. 129 positive, 202 down more than 20%. Only 119 stocks announced earnings this week. So we're getting towards the end of the earnings period, which is good because the next one starts in about 3 weeks. GameStop beat earnings down about 7.75%. Old Dominion, which is a freight company, down about 3.5%. They beat. Dave & Buster's, I don't know, what do you call it? Not adult entertainment, but, go to a bar and play some video games type place, down about 7.5%. McCormick, the spice company, down about 5%. And Neo, the Chinese EV company, down just under 8.5%.
So whether you beat or miss, you're just getting crushed.
Basically, it doesn't matter. It just doesn't matter. Was it last week? Or all the companies that beat were down and those that missed were up?
Yeah.
Bizarre. Anyway, Apple had their product event this week, down about 1.3%. I don't know. There wasn't a whole lot that was all that interesting to me, except for they've held their prices for their phones at about the same level as last year, which is really interesting, I think, given all the imports that they've got that go into a phone, the supply chain issues, freight costs. I don't know. Just kind of.
What do you reckon that conversation was like around the boardroom table around pricing?
We've been screwing customers for about 15 years now. Let's give them a break.
Cut them a bit of slack.
Probably. I did read, though, that separately I read that I believe the first run of the phones are in China and then they're producing more in India and possibly more in India than they're producing in China these days.
So they produce in India at the moment?
Yeah. With such confidence. Now, I'm pretty sure they do, but I think that's relatively new.
So they started manufacturing iPhones in 2017. Oh, that's right. Remember where they had the iPhone SE, the base model phone that they were selling into the developing world?
That was made out of India.
Yeah.
All right. Okay. There you go. CVS Health up about 4.5%. It's the largest healthcare company in the US. I didn't know that. Spending about $8 billion in cash to buy Signify Health, which is a home healthcare business. This follows both Walgreens and United Health also getting into the home healthcare market. So just, I guess, a bit of a different skew on the same industry for those guys. And in some sad news, Bed Bath & Beyond CFO Gustavo Arnal died this week, taking his own life. The reason I thought I'd bring this up...
Did he jump out of a building?
Yeah, in
that's right, I read about
New
that.
York. Somewhere in New York, yeah.
And then they found... What did they find after that in his office? They found documents or...
Oh, really?
Yeah,
I don't know. I didn't read that bit. Yeah, pretty crazy. But yesterday was Are You OK Day here in Australia, September 8th. So I was just kind of mindful, just sort of reflecting on that. With interest rates going up and inflation and tons of people kind of probably starting to feel the pinch a little bit, or if they're not now, they certainly will be, I would imagine. And so I did a little bit of research, and I didn't realize this, but financial stress is estimated to account for about 20% of all suicides.
Wow, that's a big number, isn't it?
Massively high number. And men, about 75% of all suicides. So just a shout out to all the guys out there, don't be afraid to reach out. Beyond Blue, Lifeline, great services out there. Talk to friends, whatever it is. But reach out if you're
Do you
struggling.
feel like people are more accepting to have... I mean, I think we... Like, here at our office, we talk about stuff, with our kids and partners and family and life and stress. And in the last couple of weeks, I feel like we've been talking about it a bit more. Do you think that more people are being more receptive and nurturing for those types of conversations? Whereas I feel like that having that conversation is just never had. Like, it was either awkward or you don't have that conversation with your work colleagues or anything like that.
Yeah.
What do you think?
Yeah, no, I think you're right. I mean, you even think like our parents' generation, the men, you don't show emotion or whatever. And that has definitely changed. I'd like to think people are more aware and more open to it these days. I mean, there are a lot more services available than what there were in the past. So maybe that's an indication that maybe we're more open to using it. Was that
took the kids to soccer on Tuesday, and I helped the coach out because kids are out of control. I don't know how this young guy is supposed to handle these kids. So I'm that dad. So, and the parents of the other kids think that I'm part of the coaching company, and they come ask me questions. I'm like, I'm a dad. I've got no idea. Anyway, one of the kids, the goalkeeper, fell over and he hurt himself, and he got up. I said, "Oh, you okay, mate?" Because I'm on the ground in amongst them, and he's like 6 or 7. He said, "Yeah, I'm okay. My daddy said that if I fall down, I should just get back up and not cry." And I'm like,
pressure.
Okay, mate, it's okay to cry. Like, if you're hurt or something's wrong, it's okay to cry. And he's like, no, my daddy said not to. And I think about, like, that's, you and I have grown up differently. This kid's growing up like that, and he's going to have his own sort of, not being able to express emotion.
Yeah. I'd say that's, I don't know, maybe it's hard to know whether my view and experience of the, raising kids is the norm or the exception. But I'd say that don't cry, don't show emotion, don't show weakness, that sort of stuff. Surely that's the exception these days.
You reckon?
Well, my experience it would be, but
I don't know.
Maybe I'm the exception.
I don't know. I've got no idea. But I just say that because of what you're bringing up right now.
Yeah.
That this is still being passed on from one generation to the next, and from who knows how often this 6-year-old's been hearing this, and he's probably going to continue to hear it until he's old enough to sort of rebel and kind of do his own thing. I don't know.
Yeah.
How old's that? Like 13, 14? Better than I do.
At least 13,
but
maybe earlier.
You get, do you know what I mean? So you've got 10 plus years and in your infancy when you're learning and just developing. That's what you're supposed to do, or that's what you're not supposed to do.
Yeah, and we talk, like how much does that experience of growing up still influence and impact our lives, our view of the world? Yeah, even if it's we don't want to raise our kids that way because of X, Y, and Z, it's still an influencing factor. So I think, it's massively influencing, and if you're telling kids at 6 not to cry, then what's the outlet? How do they let that go? How do they tap into those emotions when they
jump out of a building,
16 or 30. Yeah, when they have hard times, like what do you do? Yeah.
I don't know,
it's tough.
So I don't know. I think there's a lot more going on. There's a lot more. I feel like people are more accepting of and nurturing of, I don't know, like this, whatever this is, right?
Hopefully they are. So
anyway,
it's okay to cry.
Totally okay. Let's move on to emerging markets.
Emerging markets down about 0.3 for the week, down 13.5 year to date. Oil down 4.5 for the week, up only 11% year to date at 82.95 US barrel. It has been belted lately. Petrol price, diesel check-in. What's diesel?
Two weeks to go, and the ScoMo, not my job. 2 weeks to my birthday. That day, petrol prices go up, guys. So,
unleaded's come back down like low 60s, high 50s.
Yeah.
I mean, it's up and down. It's crazy.
If I don't receive a gift, I will understand due to petrol prices and tough times. So it's okay.
Yeah, look, yep. And Bitcoin, last 5 days down about 2.6%, down just basically 60% year to date, and $19,321.60 a coin. Interesting, the 52-week range, 17,708 to 68,789. That's mental.
What do you think now that we know what we know about the likes of Bitcoin and cryptocurrency? Like, how do you define risk? You know, in finance, risk was always, you know, volatility and standard deviation, and that's how it was referred to as risk. Like, what is risk now? Is it the chance that something can just blow up, like whether it's an Ethereum or, well, not so Ethereum, but all the other cryptocurrencies, don't know the names anymore, that have just blown up and just blown up,
vanished.
Like, is that risk now, or is risk still? Do you think the fact that something can,
I think
range between $17,000 and $70,000?
What's still a risk? I mean, it's what, a $51,000, whatever percent that is. It's massive. I mean, it's still a risk, but I think, you know, the .com boom, maybe you would have said the same. You know, there's a bunch of companies that just vanished because they were raising money and had no real business case. But no one cared, and everyone just sort of jumped on and worry about it later. Yeah, I think Bitcoin was probably, or cryptos were probably the same thing. Maybe this is their .com bust moment, and Bitcoin is having their Amazon moment, or, you know, whoever. And, you know, you get rid of the crap, and the legitimate ones survive and evolve into whatever they're going to evolve into. I don't know if the definition of risk has changed, but I kind of feel like, I don't know, maybe I feel like volatility, and I've mentioned this a few times, I feel like it's just that the highs are higher and the lows are lower.
The highs are high and the lows are lower.
No, it's purely just based on nothing other than just kind of what I feel like. I just feel like
with what's going on now,
throw it, you know, quicker to get in and quicker to get out. You get a lot more up and down.
More volatility, more risk.
Yeah, maybe. All right, economic data. Some interesting stuff that's come out over the last week. Last Friday, US job numbers for August were released. 315,000 new jobs created. That was down from July's 526,000, which was extremely strong. The unemployment rate increased by 0.2 to 3.7%. So pretty still very, very low. The Aussie June quarter GDP came in at 0.9, annualized 3.6, really strong. Following that, the RBA raised rates 50 basis points to 2.35%. Look out for the letter from your bank. That's coming. And in comments at the Anika Foundation, Phil Lowe said, which I think is really interesting, although kind of had probably left me with more questions than answers, but we are conscious that there are lags in the operation of monetary policy and that interest rates have increased very quickly. And we recognise that, all else equal, the case for a slower pace of increase in interest rates has become stronger as the level of cash rate rises. I mean, I don't think that's groundbreaking.
But it's common sense and sensible to me. It's what it sounds like.
Yeah, but also I think what he's saying is we've got more rates coming.
Yeah.
Next month might be 25 or 50, and it's probably an increasing chance they're going to be 25 going forward than 50. But there's more coming. He went on to say, but how high interest rates need to go and how quickly we get there will be guided by the incoming data and the evolving outlook for inflation and the labour market.
Data dependent, right?
Data dependent. But the labour market, I think that's the key. Like, that's the key for them. That's the one they're watching closely. So they'll keep putting rates up as long as the labour market can take it, I think.
Do you know what the Australian 10-year yield curve is sitting at now? The 10-year?
I know that's moved. Well, actually, I know the US has moved quite a bit higher. No, I don't know.
Take a punt.
I'm going to say like 2.7.
So 6 months ago, the 10-year was 2.32. A month ago, it was 3.23.
Well, hang on. 2.3 and 3.2. So
gone
0.9.
up.
Yeah, far out.
Currently, as of yesterday, the 10-year is sitting at 3.67.
Holy shit. Really?
Yeah.
Wow, that surprises me.
And so it's moved in the last couple of weeks. It has moved significantly.
Yeah, okay. And stocks haven't fallen that much for that size of a move.
See, that's the conundrum, right? Like if you think about the stock market as a forward-looking machine, why it's this conundrum of rates are still going up. Mm-hmm. If there's a recession coming, and if there is this recession, why is the yield curve still steepening? And if there isn't, why is the stock market down?
Yeah, I don't know. And it feels like the stock market and the bond market have been at odds for most of this year, although they have both declined, but I feel like they just, they could both have it wrong, or they could, one's got
to be right.
And one's got it wrong, but the bond market traditionally has been the more accurate forecaster, I think, of general economic conditions.
And so if the bond market's saying,
then
if you look at it's a steepening yield curve, and it flattens out from about the 20-year maturity profile, and then it flattens out to 30 years. I mean, understandably, but it's a rising yield curve. And the stock market's saying, I'm calling the bluff.
Yeah.
Certainly over the last couple of weeks since we had Jackson Hole and Jay Powell speak, and we had rates rise in Australia.
This is Australia, right?
This is Australia. The Australian yield curve.
Yeah, right. Yeah.
And stocks have come back quite a bit.
But you look at the US yield curve, it has been inverted for, I don't know, good couple of months now. I mean, the 10-year US is sitting at 3.248, which is higher.
That's one wonky yield curve.
Yeah, but the 1 year is sitting at 3.5. Even the six month is sitting at 3.4. So yeah, it's not straight down. But I mean, over the last month, the US yield 10-year bond rate is up 50 basis points. That's a pretty big move, 2.7 to 3.2.
So we're at 235. If you remember a little while ago, the market was predicting at the end of, do you remember the RBA wasn't going to raise rates till 2024?
2024. Still waiting for that, Phil. Come on, mate.
Do you remember? So it was at 3% back into 2022, 2023. Now we're at 2.35. Mm-hmm. So we're pretty much on the money on that one. But the market's predicting getting close to 4% now. Cash rate.
Yeah.
Do you think it's overcooked?
Wow. Yeah, I would have said, I think I did say, and I probably still believe that 3% is going to have a pretty damaging impact.
I agree. It's starting to have an impact now, and we're just starting to feel the circulation of the rate rises through the economic plumbing.
Yeah, and how many rate rises have we had? I feel like, was it May the first one?
Yeah, it was.
I feel like
May was the first.
Your mate, Christopher Joy, came out and said, I think you were telling me, that, or reiterating someone else's comment, maybe you should tell the story, about the 3 to 6 month lag from the first rate rise.
Yeah.
So if that was May, what's that, May?
Yeah, so I wrote that.
No.
I wrote about that in the blog.
Oh, did you? I should read your blogs.
So what I was saying was, and I shared that chart that you shared, which was from Schwab, that looked at interest rates and the net interest rate hikes from central banks around the world. So the first rate hike was 4th of May, 25 points, and then went 50 in June, July, August, and September. So we've had May, June, July, August, September, October, November. So we're now, I feel like now, and I think Gareth from CBA was saying that it takes 3 to 6 months for interest rates to start to have an impact in the economy. And so if Gareth's right, and I just intuitively I feel like right, it feels right.
Just tipped over that 3 month mark.
What? May, June, July, August. So we're month 4.
To June, July, August. Yeah,
we're just now feeling the initial rate hikes. And every rate hike after that, every month from now on,
to the
you
end of the
start
year.
to feel every single hike that came out.
And that first one was 25, right?
Correct.
Then we went to 50, 50.
Which, and you might say, forget the first one because that's nothing. And so then you go 50, 50, 50. Maybe you're not going to feel this stuff until early in 2023.
Yeah.
The economy starts shitting itself. The RBA is going, let's just hold off here.
Yep.
And to your point, rate cuts are far greater and quicker than rate rises. Rate rises are a very slow, prolonged process. Rate cuts happen bloody quickly. There's no time in history where you've seen prolonged, slow rate cuts. You're on a
25 here, 25 there. It's like bang, bang, bang. Just
you're on a downhill slope, and you got to pull that handbrake.
Yeah. Yep. Interesting. So, but rate cuts are happening around the world. So Canada raised by 75 basis points. I think they're now sitting at in the threes, 3.25. And last night, ECB raised by 75 basis points, hinting they could do more of the same for several future moves. So it's another 75.
Yeah, I mean, you can't expect anything else, really.
Well, I don't know. We'll talk about Europe in a little bit.
Okay.
I'm just going to bring this chart up really quickly. This is kind of on the back of what I talked about a couple of months ago. Some of the rate rises that we've had over the last year across various countries. You can see Brazil and Mexico, the emerging market countries, are the standouts there. Now, this is old because Australia has risen by 50 since this chart. Canada 75 and Europe 75, but
look at Brazil, man.
750.
750 points.
I mean, if you're going hard, go hard, right? But yeah, even the US 225, and they've got a meeting coming up this month, and I'd be shocked if they didn't do another 50 at a minimum, but I think it'll be 75. That'll get them to 3% this year. I think they'll go another 75. I think they've got more to come. And we've talked about, the structure of their mortgage market and all that. I think that all that plays into it. Their unemployment is still very, very strong. And the strong US dollar absolutely helps on the inflation side, helps, purchasing. It also helps every other country around the world exporting into, into the US. So, that's an interesting dynamic. If the US comes off the boil, they might, I don't know how that impacts, but anyway, we're getting distracted.
Why? You may not know this, but why is Indonesia so? Look at their 1 year change.
They've done nothing. What are they?
Have they always sort of had a? They haven't had to. I mean, they've only made one change.
What were their lockdowns like? Apart from Bali, I don't know that they had.
I don't know, but if you look at that, their cash rate would have been sitting at 350,
3.5. And
so they were higher than most of these, other than the likes of Mexico and Brazil. I was trying to find what the Zimbabwe. Remember we looked at this? Zimbabwe's
their inflation was like 80,000% or something ridiculous.
It was pretty crazy. I'm trying to see what their cash rate is at the moment. I don't know if this is right. It says it's 200%. In June. So interest rates in Zimbabwe averaged 49.17% from 2019 until 2020, reaching an all-time high of 200% in June of 2022. Wow. Who wants yield? Can we redefine risk as well?
By the time the money comes out of the ATM, you need more money.
Bloody hell.
Process, that's crazy. All right, so moving on. China trade surplus dropped from 101 billion US down to 79 billion. It's probably a reflection of their extreme lockdowns. In Europe, Germany's factory orders dropped 1.1%. A drop of 0.4 was expected, and their August construction PMI at 42.6 from 43, so solidly in contraction territory. Eurozone construction PMI fell to 45, fell from 45 to 44, and June quarter GDP came in at 0.8, which I thought was really, really strong. Year-on-year GDP growth at 4.1, which is bloody strong. So they got some more rate rises coming. And that's it for my market minute. 20 minutes.
We're going to change the name of that segment. So the thing that I want to talk about is, in my topic, the 60-40 portfolio. It's no news that stock market's obviously down, bond markets are down. But for investors, it really feels painful at the moment because you can't. What your portfolio is supposed to do from a diversification perspective, it is not doing.
Happening. Yep.
It's not happening. And so I want to bring this first chart up. This is from Bespoke. I think they put some pretty cool things here together. So this shows the worst year on record for the 60-40 portfolio. And it's for those listening who don't know what a 60-40 portfolio is, 60% in stocks, 40% in bonds. It's your sort of rule of thumb balanced portfolio that's used around the world.
Yep.
And in fact, some of the headlines are suggesting that this is the worst fall on record since 1936. But I don't know if 1936 there ever was like a 60-40 portfolio.
Right.
But I think what they've done is they've put the data together and said, even if there wasn't a 60-40 portfolio, this is what it looks like. And so you're down 14% year to date through to August, the end of August, you're down 14% on a reasonably well diversified portfolio. I'll bring up this next chart now, and what Bespoke then said was, well, if you then added commodity exposure to your portfolio, and so what they did was they put together a portfolio that was equal weight, fixed income, equities, and commodities. So 33, 33, 33.
Right.
And so you can see how it cushioned your portfolio from being down 14% to being still down, but relatively speaking, only down 1.1%. Third chart, diversification to commodities reduced returns and lowers volatility. So you have a look at the annualized returns on the far left. For the 60-40 portfolio, it's close to 10%. If you added commodities in there, your return drops by about 120 points per annum for the last 30 years or whatever it is.
Yep.
You have a look at the annualized returns for the last 10 years. You know, your returns halved by adding commodities in there. You have a look at the standard deviation or risk for 1976 and for the last 10 years. Commodities do help reduce the volatility, but we can start to see here that it also has reduced investor returns
significantly. I mean, for I don't know what percentage drop that is. Let's call it a 10% drop in volatility. You've got a 50% drop or thereabouts in returns.
So let me bring this chart up as well. Commodities exposure, Bespoke's title is long-term pain, infrequent gain. This is the relative performance of equal weight fixed income equities commodities relative to that of the 60-40 portfolio total return.
Okay. So above the line, the commodity, the portfolio that includes commodities is outperforming the 60-40. Below the line, 60-40 is outperforming.
Basically.
A lot more below the line.
A lot more below the line.
But when it's above the line, well, I was going to say it's well above. It's not. There's a couple.
But to Bespoke's point, long-term pain, infrequent gain. And so you do have infrequent gains, but as long as you're seeing it through and you're riding the investments out and that period out, like why would you start holding the commodities?
Yeah, I mean, it's so cyclical, and I think this just highlights it. And we've talked before that volatility is the price of entry. You know, it's what you're signing up for when you get into equities, and you can try and diversify that away, but we know that reduces your returns. And you know, including and 33% of your portfolio in commodities is a lot.
That's a big number.
But you know, for illustration purposes, I think it highlights that commodities, I don't know. In inflationary times, it's good. Non-inflationary times, not so much. And trying to pick that is difficult. Yeah, I think that previous chart, the 9.92% return since 1976 of a 60-40 portfolio, pretty good. I mean, it's pretty hard to argue with that, right?
100%. I mean, you talk about commodities. I mean, if I just have a look at the price of gold. It's basically done nothing. It's traded sideways for the last
which is fascinating given the inflationary environment.
Well, see, that's the thing, right?
Like what?
Like in
is
theory,
it gold meant
that's
to be the hedge?
Supposed.
And Bitcoin.
Well, Bitcoin wasn't the hedge. Price of silver has gone from its peak in 8th of March 2022. I can't March. So we're down about. Oh, this is the worst charting software I've ever seen. What the hell is this? It's down from $840 to $600. So what's that? 25% decline on the price of silver from its March peak, and gold's no different. Yeah. You've got $65,000 a kilo down to 55. What's that? 15%? 20%.
Oh, a kilo.
A kilo.
Yep.
So that's another 20% decline in one of the highest inflationary periods.
We've had.
Or is this saying inflation's peaked? So some food for thought there. The data's saying that commodities do help, but you got to get. I reckon you got to front run it. You got to get ahead of it before it happens, and then you got to get out because the damn thing can turn.
Don't hold it for the
quick.
long term.
This final chart I just want to bring up as well. It's from Vanguard. What they did was they looked at the percentage of time periods with negative total returns. On the top, you've got stocks and bonds both negative. And so what the bubble shows is, on average, this is since 1976 as well, on average, almost 15% of the time, stocks and bonds both go negative.
Okay. On
a 1 month average. Over a 3 month period, 8.5% of the time, stocks and bonds are both negative. 6 month periods, stocks and bonds go negative 3.6% of the time. But then you have a look at 1 year and 3 years. Vanguard point out that since 1976, investors never encountered a 3 year span of losses in both stocks and bonds. The 1 year number is 0.4. That's a really low number.
Basically zero.
So in the short term, in 1, 3, 6, 9 months, even going up to the 1 year, there is, and the probability diminishes rapidly.
Yeah.
Beyond the 6 month period.
Yep.
And so we're in month 9 now. Don't ask me what those grey. I've read the paper. I don't understand what the bottom numbers are.
60 stock, 40 bond portfolio negative.
Is that saying the portfolio is negative? So if you had 60% stocks, 40% bonds?
I think so. Over a 1 month period, there's a 1 in 3 chance.
I don't understand how that's different to stocks and bonds both negative.
Well, I was looking at it going, if stocks and bonds have never been both negative for a 3 year period, then how the hell is it 60-40?
I read the paper like 3 times.
Yeah, okay.
So Vanguard,
give us a shout out.
Explain the chart, please. But I'm focusing on what they're pointing out. They're pointing out that since 1976, investors never incurred a 3 year period of losses in both stocks and bonds.
Yeah.
And so I think the point is, like, in the short term, a lot of stuff can happen, but it's just widening out that horizon to be able to ride out those ups and downs.
Yeah, look, and I think we've talked about it so many times that stay the course. Investing is for the long term.
But it's hard. Like when you're there,
hard. Absolutely.
Day to day, you see a portfolio. I mean, when we talk to investors and talk to clients, they're at a point now where they're just saying, I don't even look at my value anymore.
Yep.
The only time I look at it is when we talk to you guys.
Yeah. And we're going to stop showing clients their portfolio value. But no, I don't think that's a bad thing. And the thing is, you tell clients that when times are good, when the portfolio is getting 20, 22%, like, no, it's all good. But as soon as we hit the skids, everyone's like, shit.
Yeah, don't look.
Don't look. We were chatting to a client a while ago saying that checks his portfolio 2 or 3 times a day. Like, man, that's do your job.
And in this environment, that could be a pretty wild roller coaster, right?
Yeah, absolutely. I mean, the emotional roller coaster, the stress that could cause is huge. It's not worth it.
So look, there's. I'd like to say I feel like we're through the worst of it. That's what history tells us, but you and I both don't know. So let's move on, and we'll touch on a couple of things later.
Speaking of the worst of it, hello Europe. So I've been reading quite a bit, just curious and just kind of letting my mind wander as to what the hell, how does this play out in Europe? So for a bit of background, we obviously know they're facing some challenges with Putin going a bit crazy and invading Ukraine. So considering these challenges that they're facing and listening to some of the language coming out of the UK and European governments and some of the actions that they're now putting in place, just wondering, how do they avoid disaster? And I mean, recession, definitely. Does it get worse than that? like, could they go into a 18-month, assuming the war continues and gas prices stay where they are, could they have like a 18-month, 2-year recession? I mean, the Bank of England came out a little while ago saying expect all of next year for the UK to be in recession. I mean, that's pretty bloody dire. So I've been looking at a few things. So the UK have got a new Prime Minister, Liz Truss. Man, I bet she's kind of wishing that she didn't inherit that job right now. So the energy crisis in Britain is pretty severe, as it is across most of Europe.
And Australia, in the Baharian household.
Well, for Origin it is. AGL are licking their lips going, just crank up that heater. But, you know, they've had massive gas price increases during summer. And that's the kind of thing that sort of struck me. I was sitting back going, oh, fuck, they're on the brink of winter. And this is just going to get worse, I think. So a study by the University of York predicts that over half of all of UK households will be trapped in fuel poverty by January 2023.
Hold on. Half of
UK households
will be trapped in what?
What they call fuel poverty.
What does that mean?
That is that they're struggling to pay their energy bills. So if they're struggling to pay your energy bills, the Baharian household in winter, surely that's one of the last things you don't pay. I mean, bloody cold in the UK in summer, let alone
because
winter,
it just gets shut off. That's the consequence, right?
Yep. So the UK government are obviously acutely aware of this issue. So they are apparently putting together, or expected to be putting together, a £200 billion energy package for households and businesses across the UK over an 18-month period to help pay for their energy bills. So £200 billion.
Putin's rubbing his hands.
Yeah, although it's interesting that oil prices have fallen off just as far as I have. Gas, I haven't looked at that. Anyway, so for a bit of context, they spent $310 billion during the COVID pandemic supporting houses. 310
billion.
Yep. Pounds.
During the COVID pandemic, right?
COVID. Do you want me to repeat that?
No.
You got that? Yeah.
It's all good. Bit slow this morning.
Big night. I knew you had a big night. So this is at a time when the Bank of England is obviously raising rates to try and tame inflation. So the UK government are pumping tons of money back into the UK economy. UK's national debt is £2.3 trillion. So another 200 billion is 10%. So adding 10%.
That's a big number, isn't it?
That's just for energy. Like, imagine if unemployment starts to spike. Like, anyway. So, so essentially the solution, and it's not just confined to the UK. So I did a little bit of digging, and the following countries are offering financial support to their citizens and or utilities, companies and businesses generally. So the UK, Italy, Spain, France, Denmark, Germany, the Netherlands, Greece, Norway, Bulgaria, Finland, Hungary, Poland, Romania, and Sweden. That's basically all of Europe. Basically.
Just to answer your question, price of natural gas has gone from back in 2020, the lows of, $1 a unit
per British bushel or British thermal, whatever they call it.
Metric million British thermal unit.
That's it. Good job.
And so like $1 something. And it jumped up to, in 2021, $6. It jumped to $9.94 early this year. Its peak was $9.71 in 3 weeks ago, but since then it's dropped about 20%.
Oh wow! Okay,
$7.77. So I don't know. It looks like it's peaked. Is someone turning the gas, the pipeline? Just
literally. Hey, no one's looking. Just open it a bit. So Finland's economic affairs minister commented that this has the ingredients for a kind of Lehman Brothers of of the energy industry. So Finland is offering about 10 billion euros, Sweden about 23.4 billion euros in a government program that's kind of like financing of last resort for energy retailers and utilities.
So are they helping out the households, the utility retailers?
They're helping out the households, but this is a separate kind of insolvency fund. So because a lot of the energy companies hedge, right? Yep. So because they're hedging prices and prices are moving so much that they can't meet their margin call. So this is a fund that they can tap into. If they can't tap into the market, then they can sort of tap into the government coffers, if you like. So I'll bring up this chart, and this is from someone somewhere. I don't even know. I've got a link there. Anyway, this is
Statista.
it is Statista. I was going to say that, but I couldn't see them. Anyway, so this is the average monthly electricity wholesale price in selected EU countries from January 2020 to January 2022. Italy, 441% increase, Greece, 338, Hungary, 370, Germany, 300, France, 400, Sweden, 75, man, they've got it made, and Switzerland, 383. So some big increases there.
What happened to Sweden?
I don't know. It was interesting. I tried to see if there was any link to countries that had moved to more green energy, because there was. I read something during the week saying, well, this is all terrible, but part of it is their own fault that they went from fossil fuels to green energy so quickly that they became so reliant on external energy sources that they're just at the mercy of Russia, as an example. But I couldn't really find anything that supported that. And I don't know what Sweden have done in the past. So, and I'll just bring up this chart here. So, European countries that depend on Russian gas, Finland, Bulgaria, Germany, Italy, Poland, France, Netherlands, they're all fairly significant. Interestingly, Germany, I think we've mentioned this, have started mining coal mines again. Nuclear energy is now back on the table after a number of nuclear energy plants were shut down over the last number of years. So, not great for long-term environmental sustainability, but certainly I think when push comes to shove, if you've got unhappy citizens, you do whatever the hell you can to help them afford heating and all that. So it will be pretty interesting to see what happens over the next little bit when it comes to gas prices.
Can I just throw something in there while you've been chatting? It's been interesting to just kind of hear what's triggered a lot of these things. I've just put that in the doc now. This is gas prices.
Oh yeah.
So there was in 2005, 2006, we had the Ukraine-Russia gas war again. I don't know what happened in like 2007, that third spike, but it appears as though these spikes are just sharp and quick. And then they peak off and...
Interestingly, though, this is in US dollars, given how strong the US dollar is against the pound. I mean, they're talking about potential parity between the US dollar and pound, which is massive, and we've got parity in the euro. But I guess it's good for the Americans, not for Europeans.
Well, I think the Europeans are importing gas from the US.
Yeah, they are. So it's just getting more and more expensive for them.
That's the thing. It's like you can't win.
So a couple of other things. So today the EU energy ministers are meeting to discuss implementing price caps on energy, which Putin has said if they do that, they're just going to stop exporting to Europe altogether, like just shut it down. And Russia recently shut down Nord Stream, the pipeline going into Germany. I think they've completely shut it now. So there's one going through the Ukraine, which obviously is in the middle of everything that's happening there. So just bring up this last chart and then I'm done. This is the Gazprom, the big Russian energy company. And this is their gas exports to Europe. Like, look at that. Since June of last year to June of this year, like it has just...
What's the black? Oh, no, it's Nord Stream flows, right? Gotcha.
Yeah. So this talk about weaponizing energy. I mean, it's 100% what they're doing. I don't think anyone's surprised by that, but I saw that chart and was just kind of shocked at just the dramatic drop off. And you hear about, and you read about, Nord Stream being closed for maintenance, and will they reopen it? And I kind of just thought it's all just political posturing, but no, I mean it's actually happening, and it's happening not just the Turk stream, which goes through Turkey, and the Ukrainian one, and Yermal, which I don't know, Poland, I think. So I mean it's kind of happening across the board. So pretty interesting. Pretty, it's kind of a bleak outlook, I think, for Europe generally over the next, 12 months, presuming the war continues, and it doesn't look like it's going to end anytime soon.
I feel like we're just so distant to all of that, though.
We are. Which is why some of these just really shock me, because I'm just like, oh yeah, prices are going up.
Like, 400%. Oh, yeah. But unless you're there kind of living it and really feeling the pinch, we're whinging about petrol prices at $1.90 or whatever it is, but these guys have got gas bills coming in the thousands of pounds, a month or a quarter, whatever it is. Like it's just ridiculous.
Yeah, just going up quarter on quarter in summer. Like, look out for winter.
Yeah, I just think we just got to watch this space, because that will be a big one. Anything else you want to cover off on that one?
Mate, I think I've talked enough today.
Uber bullish on Europe, clearly.
Yeah.
I think we'll wrap up. I'll do this one really, really quick, and we'll get into director's cuts. So this is from Sentiment Trader, and they titled it, "This is the most remarkable chart that we've ever seen." So if you remember in 2020, there was this frenzy of these small speculators that were just going absolute bonkers and absolute bananas with options trading. Do you remember that?
Like the meme?
Yeah, there was correct. There was meme stocks.
Yep.
And I think we actually shared this, and it was from Sentiment Trader, that at the time that was the most remarkable chart that they had ever put together. And they say, until now, and quote, "This time it's not small options traders that have panicked, and it's not FOMO that's causing it. Rather, it's the largest traders in the market, and they're buying protection against a crash at a pace unlike anything the market has ever seen before. Last week, traders of 50 or more contracts bought to open nearly 5 million put options. More importantly, they spent a whopping $8.1 billion on those contracts.
Cow.
That is almost double the amount of any week in the last 22 years.
Jeez.
And so I'll bring this chart up now.
Holy cow! Look at that.
If you can see that. So they net out the net speculative options. So the puts and the calls, they just net everything out, and this is where it's at. Last week's panic hedging was 3 times more extreme than it was in 2008. Have a look at the spike positive in the far right hand. That's investors just going absolute bananas and bonkers, if you remember, in 2021.
Yep.
And when Sentiment Trader put a chart together, it said, "Wow, we've seen nothing like this ever.
Yeah,
we've never seen the market this bullish before."
Wow, look at that!
And now
That's crazy.
It's literally like that line has been flipped vertically, and it's now exactly the opposite way. They go and say institutions bought a record amount in.
Like, I wonder why last week. Like, what was it in the last week? I don't imagine but in the last week, something has obviously triggered an enormous stampede across multiple institutions, not just, was it Jackson Hole? Is it a result of that?
I mean, that conveniently lines up with,
one, right?
with that. I mean, they go on, they say, so why hasn't the VIX or the fear gauge spiked along with this scramble for puts? And they go on to say it could be due to a number of factors, like traders buying puts on stocks not included in the S&P 500 or buying options with longer expiration dates. Whatever the explanations, they go on to say the data is clear. Institutional traders are at a mad scramble for protection right now.
Yeah, it's interesting that, because I've been watching the VIX, and it's really interesting to sort of watch that. And it hasn't really done a lot. I mean, for the year it's up, but you look over the last month or so and it hasn't reacted to the extent that market swings have reacted. And for a lot of this year, you've been able to buy that VIX volatility hedge at what I'd say are probably pretty reasonable prices, if you're that way inclined. But
and so if the market was if this was any indication of what was to come back in 2021, and that played out, like, I just wonder if there's something that institutional traders know of. I mean, it sounds dumb as those words come out of my mouth, but because no one knows.
The crystal balls are finally working, and they're just going short.
They've run out of battery. They've plugged them back in. They were unplugged because of not electricity prices. I was going to make a joke.
No energy supply.
Didn't work.
Yeah.
So I don't know. Like that's really interesting to me. But
yeah, that's interesting.
But
it's fascinating.
Yet again, we are being presented with conflicting data, and what was supposed to happen under certain circumstances in various areas of the market just have continued to prove everybody wrong.
Yeah. Yep.
And so I think it's just one of those things that you look at and you just have to take with a grain of salt because...
yeah, I think it's more noteworthy as well because it's professional institutional investors, which, do they know more than us? Who knows? But they tend not to be as flighty as retail investors. But at the same time,
extreme. We've shared charts in the past whereby you look at when institutional investors have gone to cash or overweight equities.
At wrong times. Yeah, I mean, they're human
beings.
At the end of the day, unfortunately.
That's the thing.
Like the rest of us.
So, I thought that was worth noting. And, it's extreme on one side, extreme on the other side. Maybe we start normalising. Who knows?
Yeah. All right. Director's cuts, mate. You're up first. What do you got?
So first one I've got, I read this article on CNBC. Former Apple engineer accused of stealing automotive trade secrets pleads guilty. So this guy that was an Apple engineer, he left Apple. Let me try and remember exactly what happened. So he left the US. I can't remember whether he managed to land in China or whether they caught him at the airport leaving for China. So he was leaving. So this guy Tianlang Zhang, a former Apple employee, was accused of stealing computer files to trade secrets about Apple's secretive car division. Pleaded guilty in federal court in San Jose on Monday. So he faces as much as 10 years in prison and
10 years and $250,000.
$250,000 fine for theft of trade secrets. Just trying to see where he got caught. So he was accused of taking reference manuals and PDFs describing Apple's prototypes and prototype requirements.
Wow.
So he was arrested by federal agents at the San Jose airport, where he planned to fly to China. And he previously worked for Apple since 2015, most recently on their hardware, in their autonomous vehicle team. So pretty ballsy. Like this engineer takes documents and prototypes and secrets for their automotive cars, flies out from San Jose and trying to fly to China and just gets busted.
I mean, imagine him sitting at the airport like, I've got it, I'm good.
Damn it. Just don't. How did they find out about that?
Yeah, I don't
know. The other thing that I thought that was just interesting. This was fascinating to me. Now I think in Portugal it is now. There is a robot that has like these mechanical arms, and it goes and Have you opened the link?
Looking at it, yeah.
And it's just this. It's got these arms and it picks berries and it detects the berries when they're ready, when the fruit is ready to pick. It's got 4 arms and it applies the pressure on the stems rather than the berries so that the berries don't get damaged. And this thing, so there's 2 of them now that are working in farms in Portugal. So, and the fruit of their labour is on sale in UK supermarkets already. So fruit pickers, your job...
Days a number, champ. Just get out there while you can.
And it just looks so... elegant the way that this thing is.
It's really slow. Man, take all day just to pick a
bloody
punnet.
hell. That's why berries are more expensive now. It takes longer to pick them.
Well, there are machines that go out there and...
But they're also via drones as well now.
I just saw that. How crazy is that? There's machines that go out there and shake the trees, and all the apples fall out and then they hoover them up or something.
But
literally got
drones and robots are going through and picking. So 85 million jobs could be displaced by automation.
Whoa, really? Wow.
I don't know what year, but that
by 2025, it said.
It's 3 years away.
But 97 million new jobs could be created. So it's a net benefit.
So yeah, whether that means fruit prices are going up or down, I'm sure there's a reason for both. Finally, from me. I saw this in Bloomberg. Do you know about this thing?
No idea. I just had to look it up.
Searches, so popular sports. Pickleball is now the number one searched sport this summer in the US. Do you know what?
For those who don't know what pickleball is, Rob.
I was going to ask you. Well,
I had to look it up.
So pickleball, and we'll share the links in the post, but pickleball is like...
It's like tennis.
It's like mini tennis. You're on a mini tennis court with a mini tennis net, but you've got like these...
Paddle?
They are. So imagine like rowing paddles, but you chop the whole handle off and you've just got the end paddle. And you're playing tennis with like a tennis ball that looks really light. Did you know about this?
No.
But it's been around for a really long time.
I feel like I heard someone talking about it a little while ago, and I asked them what it was, and I just lost interest.
But there is, it's if you compare it to badminton and table tennis,
So it's like standing on the table of table tennis.
It's like
that's what they look like.
We'll share the link, but it's literally a mini thing. I thought you being in the US would have been a thing. Like, look at the Americans, man. Look at these sports they're creating.
No, they're just...
Like, was tennis, table tennis, badminton not enough? That we had to, like, amalgamate the three and create...
We need more, damn it.
And it's called pickleball. I don't even know, what does that even mean?
Who knows, man.
Anyway, that's... so this things that I came across
Crazy.
this week in my readings.
All right. One thing I saw from Statista, we'll bring this up now. This is in the European football leagues, the summer transfer window closed and the numbers are in, and it would appear that the Premier League has far more money than everyone else combined, pretty much.
They need to give the money to the UK government for this energy crisis.
Now, there you go. That's a good idea. So the net spending on transfers, so revenue less the money they actually spent on transfers, 1.3 billion euros. So the Premier League spent 2.2 billion euros basically buying players in over the summer, which is significantly more than ever before. Serie A, the Italian league, was the second at 750 million. So it's at three times more. So in Europe, there's been a real move, especially in the UK. They've really embraced like billionaire owners. You know, the Saudis and these guys have gotten in. A bunch of Americans own Premier League teams now. And they're all like just loaded, and they're just spending money like crazy. But in addition to that, the new UK or the new Premier League TV rights have come in, and they're just
bonkers
printing money. Like, it's just absurd how much money TV companies are paying for the rights to show
Isn't
the
there
Premier
a crisis
League.
in Europe?
Not in football.
But what about the viewers? What about the spectators? What about the fans?
Yeah, well, it's interesting because they were talking at the start of the season. I was listening to podcasts, and they were talking about price rises for tickets, ticket price increases. And there are a couple of clubs that were sort of outliers, but the majority, I think from memory, hadn't increased prices all that much. It's all TV money. So maybe where it's coming in is, your BT subscription or your whatever.
Yeah, but who's paying for these subscriptions?
ITV. The viewers.
That's what I'm saying. They're still paying.
Yeah. But
so
it's
where's
just,
this crisis?
Well, what are they giving up? So if you're some bloke in Northern England, you're probably more willing to pay a little bit more for your TV subscription than you are to...
Turn off the gas. Put a blanket on.
That's it. Just the cheering and jumping up and down, that'll get you warm.
Warm up the bloodstream.
So it's crazy. But there's also, been concerns for a little while that the rest of Europe's just basically going to become a farm league, and it's all about the Premier League. So I don't know how this ends. I don't know how the other European leagues kind of answer this, whether Super League eventually comes into play because the other big teams throughout Europe just can't compete, and Super League's the only way to make it happen. I don't know, but it was just kind of an eye-popping difference there.
Do the I don't know about much about buying sports teams, but is the whole
I do
premise of it like you somehow manage to buy these great players and get your team just A grade and then flog it off again? Like, what's the... No,
so it's all about the prize money. So, in the Champions League, so you've got your domestic leagues like the Bundesliga in Germany, Serie A, and Premier League. So the top teams go into the Champions League, and the money there is enormous. Right. So depending on, so every win you get in the group stage, you get like 3 million euros, I think, for a win. And then you progress to the knockout stage. And the further you progress, I mean, you could make, don't quote me here, but I think like 60 million, maybe more, 80 million if you win it.
For the team.
For the team, for that 1 year. Plus you've got your domestic money for winning and all the rest of it. So the money's huge.
It's $100 million plus business.
Oh, easily. That's just prize money. That's not, TV money and gate money and advertising
products.
and all that. I mean, it's huge
merchandise.
Money. Yeah, absolutely. So, the Premier League, it's by far and away the best league in the world and only getting better, I would say.
Bonkers.
All right, and last one, little quiz for you, mate. What is the biggest social media platform in the world? Do you know off the top of your head?
TikTok.
Not even close. Not even close. YouTube.
Hold on.
Sorry, mate.
No, mate, I've got no idea. I don't know
YouTube.
why. Oh, YouTube.
Yeah.
Oh, based on what? Users or?
Based on users, but any metric you want to use.
Really?
Yeah, crazy. So here's a few numbers for you. So in India, there are 325 million monthly active users. That's more than the entire US population, or pretty much. Just in India. Mental. So 700 million, here we go. So in January of this year, people watch more than 700 million hours of YouTube. Like 700 million hours. I can't even comprehend that. And the last one, I'll just throw it at you, is every minute of the day, 24 hours a day, there's over 500 hours of footage uploaded.
Wow.
Every single minute.
We are contributing to that through the Wide Lens podcast. Thank you, YouTube.
Yes.
Just like Google, don't you reckon like Google just has the ability to be able to integrate these acquisitions?
Oh, yeah. Like I remember when Google bought YouTube and they were ridiculed for how much they paid. And now they earn in profit per quarter more than what they paid.
What's that other one, that other video streaming platform like professional people use?
Oh, I don't know.
And it's...
Rivs.
And it's just...
I don't know.
I've got to try and find it now. Bloody hell.
This makes for great listening.
I can't remember. Anyway, it's... Yeah, anyway.
Anyway,
I
so
can't remember what it is.
YouTube dominates.
But that was always seen as like, that is the Vimeo.
Oh, yeah.
Remember Vimeo? That was seen as like the premier video streaming. And man, Vimeo is just slow and shit.
Is it?
Yeah, man. It's just,
just
clunky. Anyway, let's wrap up. What do you got?
All right.
What do you got for,
tips and recommendations,
today?
mate. I'm kind of torn, but I'm going to go with, based on a comment you mentioned earlier. So I've been watching Hunted. Have you seen this show?
I've heard about this.
So I've been watching the US one.
Oh, wasn't there an Aussie one?
Yeah, there was an Aussie one.
We were talking about that a little while ago.
So basically the premise is a bunch of ordinary citizens. So Australia's a bit different. They kind of bust them all into Fed Square and just let them run off, and then the hunters have got, 15 minutes to start chasing them. But essentially you've basically got to hide, and this team of world experts of investigators, FBI, CIA, and all the rest of it, trying to track you down. They can use any means that they see fit.
Is it Netflix?
I think it's on. No, one of the normal, like 9,
Normal.
10.
Oh, yeah.
I think it's 10. Anyway, so in the US, I'll focus on the US because
Channel 10.
it's just a bit more dynamic. So in the US, they've got all these people, and they had 2 young dudes, college dudes, fairly good-looking blokes, and their plan was, we're going to just land somewhere and try and not necessarily pick up chicks, but try and stay at various females' houses because you can't trace it, right? So if I've never met this woman before in my life and she allows me to sleep in her backyard, how are they going to catch me? But the way they caught them was on Tinder. They put out a wanted poster, swipe left if you've seen us, or right if you haven't, and call us and we'll give you a monetary reward. And so there was this 2 girls letting them sleep, under the porch in their house, and the sister of one of the girls dobbed them in, and they had them within a couple of hours. Like they then got the license plate number of the car. They were watching the car. The license plate is picked up on every camera on the freeway. So they're tracking where the car is, they're tracking the cell phone number, and they just nail them. It was crazy how quickly they can act on this stuff. So anyway, really, really interesting, kind of fun to watch. I won't give it away whether anyone got away with the money or not. They win 250K, which is not bad. They have to survive a month without being detected. But yeah, they're listening to phone calls, they're tracking people. The way they're able to build your network of contacts is incredible. Really interesting.
It just almost goes to show like how you can't hide.
So hard to hide. Yeah.
And so they can use any means possible that they can use in real life. And they use it in real life.
Yeah. Yeah. So they're getting, a list of, so they're like, oh, we've got a ping on this, someone logged into their Facebook page. All right, let's track what the IP address of that. Where is that? All right, let's look at what their other searches have been. Oh, we've got a ping on.
What was your, you said if you were on the show, you would go to like your mates, one of your mates' properties that are under construction and just sleep in there for like a month.
Just stay there for a month and hide out. Like that's the best plan.
That sounds so dumb.
I don't know. What do you do? Build a hole and I don't know, but it's really, really interesting.
It's so fascinating. Like you sit here and you're like, oh, I could do that. You just do this and you withdraw your cash and jump in an Uber and run away.
But they're tracking you. Like they've got you every step of the way. You got to just do the opposite to what you think you should do.
And is it all live? Like someone's like following these people with a camera? Or
yeah. So I am a bit suspicious because they're like, oh, how the hell did they track these guys down? They've been hiding in the bush for 4 days and all of a sudden they're in the right area. But anyway.
In the Australian one, cool. The first thing that comes up, says, is Ten's hit show real or fake hunted?
Oh, really?
So who knows?
But the Aussie one was all right, but yeah, I don't know, just the American one. They always seem to do it.
We're back on YouTube. Dramatics. We're back on Netflix, by the way.
Oh, you're back?
Yes.
That didn't last long. What do you got, man?
Just something that I have done. Everyone used to do it during the pandemic, but just last weekend we drove up because it was Father's Day last weekend.
Oh yeah, that's right.
And we drove up to up into the Dandenongs.
Yep.
And what was just really amazing, Deb and I were in the car obviously, and we're driving through. And as soon as we there's just this moment where you go from city to just
not
forest.
Yeah.
And, the temperature just drops.
Yep.
And you start going up the windy road and just the sunshine is sort of peering through the trees. And Deb and I literally at the same time, we're just like, wow, how good is this? Yeah. And we'd just sort of forgotten how lovely it was and how relaxing it was. And how calming it was just to go back up into the Dandenongs, just through Alinda, through Callista, through just up in that area. So if you haven't done anything like that since COVID, just get back out again. Like it was just really lovely, cold weather. It was just really nice. And coming to springtime, I think we are in spring now. I think the weather would just be perfect for just heading up that way. Barbecues and parks and just bushwalking and stuff. So get out of
nice one.
In front of YouTube and the TV and Netflix and
after you finish watching this episode.
Get in the car and just head out, man. It was so good. There's a place that's probably worth going. We've been there, the Callista Tea House.
Oh, yeah.
They've got a lot of,
Is that where that was?
Yeah, that's up in Callista. Yeah,
right.
So we stopped there and that was quite good. The dirty chai was nice, but not as nice as Electra on Fitzroy Street in Brunswick, or Brunswick Street in Fitzroy. So
you own that business or something?
Hey, no man,
hard owner.
It's bloody good.
2 shout-outs.
That's it from me. Anything else you want to touch on? Or
no, mate,
we're good?
I'm all good.
Thanks for listening. We'll see you guys next week.
Cheers.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526 798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.